Good afternoon. This is Brad Dennis with BIS Commodities with your weekly wrap-up for the markets for January 18th. Start out with corn, beans, and wheat. Basically, what we saw all week long was corn trading in its basic range of 370 to 390, give or take a few cents. Most of the front end of the week, we saw prices coming off. That was due to no news on the trade front, and people were more focused on what kind of weather patterns were coming into South America. South American weather seemed to have turned from very dry forecast to a little bit wetter in the 10 to 14 day. And with that forecast, even though there's not a whole lot of confidence in it, that would be beneficial for beans, late beans, and it'd also be beneficial for safrinha planting as well. So we saw corn being taken down to the lower end of its range, about 372, 370. Excuse me. At the same time, beans were also coming down at the beginning of the week. Once again, the weather issue stabilizing itself. Plus, we wanted to see what was happening down on the lower trend line. There's an upward trend line in the bean market, and it came in around that 890 area. And I think at that 890 area in beans and at that 373 level in corn, we did see some end user pricing locally and some global pricing. So once you uncover that on the downside, that kind of stops the slide a little bit. Also, we saw wheat get down closer to that $5 area too, but that's a whole nother story with the wheat. But corn and beans went down to areas where they uncovered pricing, and then come back in on Thursday. Rumors fly around that China's going to be buying up X amount of U.S. products. The Wall Street Journal ran the article. There was even talk of Mnuchin taking the tariff off of products that we're bringing into the country from China in an olive branch or a goodwill gesture ahead of this January 30th and 31st report. And boom, all of a sudden we see corn and beans fly on up to the upside. And you got to remember too that we're in these ranges, so we've eliminated a lot of the orders in between. So, you're going to find staunch resistance up there at 84.5 in corn, which was last week's highs, and 88 on a technical level. On the downside, 73, 74 from the previous week's lows as well. So in between there, we've been at the top and the bottom end enough that it's going to move back and forth, and there's just not a whole lot of layered reports in there. Over in the bean market, that's one of the markets that you'll really see subject to headline risk, and whenever we talk about China, everybody thinks, oh, they're going to buy up all these beans and everything. So one thing you got to remember is that we lost about 2 months worth of exports out there. So what's going to happen with those beans? China's not going to come in and all of a sudden buy 2 months worth of beans from us. So that's just going to go to the ending stocks, and that's going to carry over a higher ending stock, which is going to be a little bit of a wet rag over this market. Over in the March beans, we're probably looking like 890, where we uncovered that end user buying good margins on crushing, so they're going to be buying them down around that level. Whereas on the upside, you're probably looking at 930, and until we take out one end of the range, we're going to bounce around. And we're going to move pretty quickly because, once again, same as with the corn, we've taken out a lot of the orders that are in between. So we saw that. We finished the week pretty strong on corn. We finished the week good in beans as well, so very positive there. I referenced Thursday about this talk about China buying X amount, $1 trillion worth of products and such. Well, at that same time, we did see a little bit of business for wheat go out. And with China on their mind, everybody thought it was China buying, when it probably was just Egypt coming in and buying some of our product. And it makes sense on the wheat side, because we were low priced. We keep seeing these prices go up in the Ukraine Black Sea area. So we should be garnishing some of the business. So that makes sense. But on wheat, we closed today at 524, 523, something like that. You got to get through 529 to really get things excited in the wheat, and we'll have to see if that comes down the road. Moving on into energies, OPEC was the talk of the week. We saw crude oil rally on up to almost $54 a barrel. What you're hearing is that OPEC is cutting back production, and the AI data supported that. Our rig count is down, so we're not producing as much. So what you're seeing is a lack of production, but when we go through the inventories, we see large amounts of distillates and large amounts of gasoline. So those supplies are increasing at a very large rate right now. And until we start seeing a price where that rig count starts going up, we'll probably see crude follow the stock market. And the stock market had a really good week this week. Was able to bounce back through some 50% objectives. But so in the crude oil market, we saw them follow the stock market up. We saw those production cuts that OPEC had promised come to reality. So the next level that's going to be resistance is about 55 in the crude, and we'll see if we can get through that next week or not. I referenced the stock market, one of the best weeks for the stock market in a long time. We took it upwards through a 50% retrace area, coming off the highs in back in September to the lows in December. So we've had that retracement. That didn't stop us, and we closed up above that. So there's possibly a little bit of follow through. You saw earnings come out. Now, there weren't great earnings. Some beat, some didn't, but it's enough to give it a boost and let the technicals take over. So we also saw today a classic example of getting out of a safe haven play. So back in December, you had people buying notes, you had people buying gold, you had people buying silver, and selling the stock market. Well, today we took the 10-year notes basis the March. We took them through a technical level, and we're finally getting up to that 375, 377 area on a yield, which we should be. We should be going all the way up to about a 390 yield on those. So look for further deterioration in that note market, and we saw gold come off, and we saw silver retreat as well. So a little bit of profit taking on both of those metals that were deemed safe haven plays just a couple weeks ago. Moving on into the livestock area, classic weather market. We had weather last week. We're supposed to be getting weather this week. We're supposed to have this huge snowstorm that was supposed to start at 2 o'clock, so everything's canceled this afternoon. Yet not a flake of snow has fallen yet. So we'll see if it comes or not. But the trade thought that it was coming. So you had a classic weather market for the cattle. You saw everybody buying February's and a little bit of April's and so on, the deferreds out there, the Junes and such. So past couple days, we've seen that unwind, and we actually took that Feb-April spread in cattle. We took it from a $2 carry to a 20-cent inverse back to about a 75-cent carry here today. So a little bit of unwinding of that, and you got to think, February 4th is going to be first notice day on the Feb cattle, so you've got about 2 weeks. You've got open interest still around 55, 60,000, so they're trying to unwind that February as much as they can. As of today at 3:30, hadn't seen too much trade. I heard of a little bit of 125 in the cash, 197 in the meats, but that was about it. So we're wondering if what's happening with the products based on what's happening in the cash if we don't see that kill being pulled back a little bit. So, you look back a month and we had futures at 123, and we had product boxes, choice boxes at about 116. We're down to 112 on the boxes, and we're up to 127 on the futures. So that's a big swing, and that's hitting into the margins. Don't know if the Packers are saying, hey, we're going to reduce the kill a little bit, but that is definitely something that we could see down the road. Over into the hogs, once again, hogs, big part of it was the anticipation of China throwing a whole lot of money at our egg products, and you think about it, and there's 5, 6, 700 million hogs over in China, and they've only had to cull about 100,000. So it's a very small percentage, but it's the fear that they'll have to do more to eradicate this disease, and that will bring business to the U.S., and that's kind of what the traders are playing off of right now. So we do have a 3-day weekend. Martin Luther King Day is Monday, so markets won't open up until 5 o'clock on Monday night. And things to look forward to is we're still going to keep hearing about these trade talks. And that's the important thing to bring demand back to this market, because if we do get these trade talks and they start buying DDGs and ethanol, then we can get these ethanol plants back on track. We can get them bidding up for corn, and that really repairs a lot of things. There's been a lot of rumors flown out there. I wouldn't put I'd wait till something concrete comes from the 30th and 31st meetings, and then make my decisions off of that. As far as beans are concerned, once again, you're talking about coming up to a level where you've got South American harvest going on. That's going to be a little bit of resistance up there. Plus, talking about these hogs, I know it's a small percentage, but their feed needs have really diminished enough that their meal has really gotten beat up this week. So watch that kind of scenario too, that if Chinese meal and beans continue to fall out of bed, there's no need for us to be rallying to the upside. So those are my thoughts for the week of January 18th. This is over and out.